You have two names that we don't spend a lot of time on. They don't get a lot of attention on CNBC, and one name that hogs all of the spotlight. I want to start with the B2C guys. You're picking GNUS, which is a data provider. They have a contract with the NFL, I know. And I want to hear why you like GNUS as one of your favorite stock picks.
Yeah, no, certainly. GNUS was our top pick and still is entering the year. And so they're a data provider, and it's a pick and shovel way of playing the industry. And it's a duopoly with Sportradar. So think of it almost like a TV broadcaster where there's exclusive rights with the leagues, and then they repackage those. And instead of selling them to cable providers, they're selling them to those rights to sports league or to the sports betting operators. And GNUS has the NFL contract, they have the EPL contract. We think those are two of the most important contracts in the world. And while the company's investing a lot in data rights, they actually have a lot of financial discipline. We have EBITDA ramping from $15 million last year to $50 million this year, $89 million in 2024. But one of the interesting things about GNUS that's not just them being a data provider is actually them embracing tech and generative AI. And one of the things that they're doing with their Second Spectrum investment, or with their ownership of Second Spectrum, is investing in this, it's video to 3D modeling. And I really think it could be like the next generation of broadcasting where they film the game, have cameras all over the stadium, and then take that and put into a 3D model that's how the consumer interacts with the game. So if you're watching the NBA finals last night, for example, and you're seeing Nikola Jokic making all these great passes and you want to see his point of view, well, GNUS's technology with Second Spectrum is going to allow you to do that. So I think at some point, this year, next year, that's how you'll be able to watch games either through traditional broadcasters or through streaming operators or through sports bettors. So I think it's a really interesting way of playing, not only, riding the wave of sports betting growth, especially in the US, but benefiting from this transition of broadcasting as well.
The year-to-date chart looks good. I just want to point out in the extended trade, those shares are off by 7.5%. All right, let's move on to Rush Street Interactive, which I just sat with Richard Schwartz at a sports gambling conference, and he told me he's very insistent that Rush Street Interactive is making real gains in iGaming, that is online casino games, which really are only offered in, I think, 6 states right now as it stands. Why do you like RSI?
Yeah, we like RSI because they're as you said, it's iCasino, it's iGaming. An interesting thing is that the focus of the sports betting industry, digital sports betting industry, has been on customer acquisition costs. One of the things interesting about Rush Street is that they're actually going after a different customer. So while the traditional call it 40-year-old male is the classic sports betting demographic, it's really the 45 or 50-year-old female, or much more mixed between male and female, that Rush Street is going after. And that's an interesting opportunity where you're just going after a different consumer set. And so what we think will be a major catalyst to get Rush Street stock to really work higher from here is iGaming legislation. We've been talking about the Midwest corridor for quite some time, like Illinois, for example.
Bernie, I want to fit in DraftKings here. It's basically a duopoly in the United States. 80% of the market share belongs to FanDuel and DraftKings right now. You've adopted a lot of the terminology from DraftKings, vintage and what is it, contribution, profit, positive. But basically, they're saying in states where they've operated the longest, they're already making money. What do you like about this stock? Up, by the way, year to date, look at this, 117%.
Yeah, and it's what you're seeing in that chart is the narrative shifting. In that last year, we were talking about, can this company survive or will they run out of cash? Now the debate has focused, because of this vintage data they're providing on a state-by-state basis, is what could 2025 EBITDA be? We're at $600 million of EBITDA. Consensus continues to come up closer to us. We think EBITDA is going to ramp from $600 million to 1.2 to 1.8 billion. And that's why we think the stock is so attractive, because the U.S. sports betting market is getting more mature. They've been telling us the whole time that as states mature, they should be able to get more profitable. And that's what we're seeing come through.